What's up, everybody? Nate here. So I'm out and about today, but I figured I'd give you an update on everything that's kind of going on. So the Federal Reserve just released its report from its FOMC meeting, and it's essentially going to be raising its benchmark interest rates by 0.75%, way higher than I was anticipating and a lot higher than a lot of experts and investors were anticipating as well. This is the highest interest rate hike that we have seen in the United States since 1994, and there could be a whole lot more coming, but we'll get into that at the end of this video. In addition, they are lowering their expectations for our economy and our GDP and our unemployment in the future. So with all of that being said, I want to jump into the numbers. I kind of want to explain how all of this is going to affect our economy right now and in the future, and of course the expectations that we can have from the Federal Reserve in the future as well. So without further ado, let's jump into the numbers. So I kind of already said it, but the Federal Reserve is raising its benchmark interest rates by 0.75%. Jerome Powell, the chairman of the Federal Reserve, believes this is an appropriate rate hike for right now because our economy is in a really good place. He points to a really tight labor market, and he also says that inflation is really high, and the labor market being really high is also growing inflation in that light as well. The federal funds rate in the United States is around 1.5 to 1.75, making it a whole lot harder for banks and other financial institutions to get their money. But also, we could see that federal funds rate go way up in the United States, almost double than that. In March of this year, the Federal Reserve raised their benchmark interest rates for the first time in almost 3 years. Now they are raising them for the third straight time at their FOMC meeting. They raised them again by 0.5% in May, and of course now at 0.75%. The big deal right now, though, is that the Fed is raising its interest rates, and of course expectations at around 1.5 to 1.7 funds rate at the beginning of their rate hike cycle all the way back in March, but now they are over doubling that. And if we were to see an even bigger increase in their federal funds rate, like they want to get to 3.8% by the end of 2023, well, that could mean that rates get higher than they've been since 2007, and we all remember what happened in 2007. That was, of course, right at the start of the housing bubble and, of course, the Great Recession in the United States. But that is not all. The Federal Reserve is lowering its expectations for our GDP. GDP growth at the beginning of this year, in terms of the Federal Reserve's numbers, was supposed to grow at around 2.8%, but they are lowering that down to 1.7%, and we've already seen GDP drop in Q1 2022 by a whole lot. So there is a potential that we could be in technical recession territory by these numbers. In addition, they believe that unemployment is going to grow. Unemployment in the United States has been going way down because businesses have had a whole lot of money. This has also meant that because of things like the Great Resignation, businesses can pay people a whole lot more, and they have to in order to bring on a lot of that talent. That is all going to end in 2022, and the Federal Reserve wants businesses to stop hiring people. They have called for hiring freezes all throughout the country because, one, people are making way too much, people have higher incomes, unemployment is so low, people can make a whole lot of money, and of course, two, we need to have a lot less of that money circulating throughout our economy, and one of the best ways for the Federal Reserve to do that is to raise the unemployment in our country. So the unemployment rate right now is at a historic low of around 3.7%, but it could go up to 4.1% by the end of 2023. Now, I kind of mentioned it before, but that was a lot higher than a lot of people were anticipating. So why exactly did the Federal Reserve raise their interest rates so aggressively right now? Well, most of this is because of the most recent CPI, or Consumer Price Index report, which showed that inflation in the United States was going up. It actually went up to around 8.6%, which means everything in our economy on average is rising in price by around 8.6%. That is a huge jump considering inflation is usually only around 2 to 3% in the United States. The big problem for people right now is prices going up, and the consumers want prices to come down, so the Federal Federal Reserve has to do all of the things that they can in order to eliminate demand. That is exactly why they're starting to raise their benchmark interest rates, so people have a harder time getting mortgages. People have a harder time getting auto loans and spending on their credit cards. In general, a lot less spending will go on, so supply can finally meet up with demand. But Federal Reserve Chairman Jerome Powell is a bit worried right now that we are not going to be able to reach that 2% target because we have a lot of other issues abroad, like supply chain problems, the war between Russia and Ukraine, and of course pandemic lockdowns in China. Well, that could mean that our inflation problem gets a whole lot worse, and it could also mean that our expectations for the Fed actually shift. We could see a whole lot more basis point hikes in 2022 and beyond, and they could be super aggressive. We could actually see a 75 basis point hike multiple times in 2022 in order to battle inflation. Now, here's exactly what all of this means. We are going to see demand lower in our economy. Interest rates for 30-year fixed mortgages are most likely going to go up. Right now, they're hovering at around 5 to 6%, but we could see them go to 6, 7, and even 8% over the next few weeks. Yes, I said weeks, not months. These things are going to happen very quickly. The same can be said for auto loans. The same can be said for credit cards. People who have a lot of debt in a lot of those areas, well, you might want to consider paying a lot of that off as quickly as possible because it is just going to get a whole lot more expensive as the Federal Reserve continues to raise rates. What it also means is that other countries and other markets around the world possibly could do the domino effect from our Federal Reserve. We could start to see world banks and central banks across the seas start to raise interest rates in response to the Federal Reserve. The Fed is tightening its monetary policy in order to make the dollar a lot more valuable, so that way we don't have high inflation. Remember, inflation devalues the dollar. That has happened over the last 2 years, and if the United States dollar gets a lot stronger, well, then other countries could also raise their interest rates to make the euro and other currencies stronger as well. So we could see a huge domino effect from other countries, and some other countries have started to make really big emergency meetings in response to our Federal Reserve and their aggressive rate hikes. Expect markets to continue to be volatile because this is all going to lead to a lot less liquidity and a lot fewer sales because demand is coming down. The Federal Reserve has to eliminate inflation, and the only way to do that is to make it so consumers have to spend a lot less money. They simply can't go out and get mortgages as easily as they could in 2020 and in 2021 because interest rates are so much higher. So that is going to lead to higher costs for businesses. Remember, they have to pay people a whole lot more right now, and they still have pandemic-related costs, but they're getting a lot less sales. Consumer sentiment and consumer spending is down, and they can't recoup any of those costs from liquidity and debt because other businesses and themselves cannot take on equity. They can't gain a lot of these loans to grow their business, so they're going to be struggling, and we have already seen massive layoffs, and we've already seen really low earnings reports for companies on the New York Stock Exchange. So expect the stock market to continue to go down and continue to be volatile. And as long as the Federal Reserve is raising its interest rates aggressively, that is probably going to happen. All of this is to get our economy back to an equilibrium. I've said this in the past before, but the Federal Reserve is kind of ripping the Band-Aid off right now. They have to get super aggressive super quickly in order to bring down inflation. They've been talking about this for a long time. They should have raised their interest rates a lot faster and a lot more aggressively earlier, but they didn't, and now they have to get aggressive now. That is creating a really fast domino effect for our entire economy, but they're really riding the line. Federal Reserve Chairman Jerome Powell does not want to cause a recession. He wants the data to lead what the Federal Reserve is going to do, and that is what we can expect from the Fed in the future. If inflation continues to go up really, really quickly because things escalate overseas with China or Russia and Ukraine, well, that could lead the Federal Reserve here at home to illustrate that they want to bring down inflation, but they don't want to tank our economy. So we could see a 75 basis point hike in July. We could see a 0.5% or maybe even a full 1%. It really just depends on what inflation does and where inflation is at. For me, I think inflation is going to continue to go up. Some estimates are saying we could see inflation lower to around 6 to 7% in the United States by the end of this year, but I personally don't see that happening as long as we have all of these other issues going on. The Fed can only do so much here at home. They can't fix all of the other issues in China and in Russia and, of course, all of our private businesses' supply chain problems. They simply can't do anything about that. But they can limit individual people from spending money on what's already there. They have to create that equilibrium so that demand and supply are, of course, equal once again. But that is it for me, everybody. Let me know your thoughts on this below. Let me know if I missed anything or what your expectations are for the Federal Reserve and inflation in the future. Be kind out there, and I'll see you all in the next one.